Tim Arrowood here, People's Home Equity. Let's talk about, what do we say?
Hodgepodge.
Hodgepodge of real estate topics. So we're waiting for some of those over there to come in here.
Hey, Strammer!
Yes!
So we'll talk about the elephant in the room, which is Tim's nose and cheeks that look like he's got.
Thank God, I was going to ask.
Rosacea?
No, it's actually somebody called it. It's a cream for pre-cancer cells, and what did she called it? Like chemo cream. I don't know if that's really what it is, but maybe it's a nickname for it. But anyway, so I'm all lit up. Looks like I got hamburger on my nose and my cheeks, so it'll be all right. So I actually talked to Matt early in the week. I said, what are some things, because I'm want to keep things relevant for you all about, I don't want to just come and, talk and feed you and everybody's like, I'm not interested. So I asked him for some topics that he thought would be helpful. And so this isn't in any particular word, but we talked a little bit and he gave me some ideas and I added some of my own. So he was asking me about the Jeff Clips situation, right? So evidently there'd been some pushback. I mean, maybe you heard Joey about Jeff Clips and putting on contracts. We don't want Jeff Clips. Jeff Clips is a VA appraiser that has the reputation for killing deals. So I mean, over the last 2 years, something like that, I have been.
Is this a real appraiser, or is
he's a real
Clips
No, I used to say there's this guy. I would go to office after office and I would say, there's this guy, a VA appraiser, and everybody go, Jeff Clips. Like, so everybody knows I'm not.
Tim's basically just trying to get himself named in a lawsuit right now.
Something like that. Yeah, his initials are Jeff Clips. So anyway, the history on this guy is that again, seriously, every office I go to and we talk about VA loans, they say, can we get this guy taken off the list? And there is a path to get somebody removed, but you got to have proof, you got to do different things. But anecdotally, what I hear is that he's on a mission to have what is one agent told me that this is second or third hand, so I got to be careful. But it was like, yeah, I'm on a mission to fix the market, right? So it's not his job to fix the market. Yeah, it's not his job to fix the market. His job to do the proper analysis. So what has happened is and I've had I'll tell you my own personal experience. I had, it's been about a year ago, I had a client buying a house up in the Butler area, got a VA appraiser who was, let's say they were asking $350 for the house. He came in at $315, and obviously the sellers said didn't want to move. Within a week I had another client that was a conventional loan, came back to buy the same house. I told the agent, I said, this is the experience I've had. I'm afraid it might not appraise. Okay, we'll just go ahead. It came in $10,000 to $15,000 over asking on that. And so it's just frustrating, right? So, and it's just time and time again that's been happening.
So on the VA came in low, and on
the conventional came in high. Yeah. So
From the same appraiser? Or different?
No, the different appraisers. I had both appraisals, and so I wrote a cover letter, sent it. I called the VA service center, and I told them the situation. They said, send me the proof. We'll just put it. It's hard to find VA appraisers, so it's tough to get somebody taken off. But we need to build a body of evidence, and so I sent them both appraisals. I mean, that seems pretty good. I got 2 appraisals within 2 weeks of each other, and they're off $65,000. So anyway, we haven't had the ability to affect him getting picked up. Because it's a VA appraisal, we can keep him out of our regular pool of appraisers. We have a pool, and we say we can't pick one, but there's only 5 in there. We know they're all good people. So, hey, happy birthday! So, but what people have started doing, and I think you will have as well, is they've started to put on the contracts that Jeff Clips is not allowed to be the appraiser, right? And so I don't have, I've heard people say, there's a conflict of interest, different wording, and I actually reached out to the broker of another office this morning. I said, hey, what do you put on the contracts? And she said, the appraiser, Jeff Clips, is not allowed to do the appraisal. And I was like, that seems, don't you need other proof? And her comment was, it's an agreement between the buyer and the seller, not the agent, so I think that's the difference. I don't know, right? But I'm just, that is an issue that I've seen.
So they put it in a contingency?
Yeah. They
So
said,
how do you approach that as a lender?
Yeah.
well, basically, we just pass it through. And so we have to order the appraisal. We have to order the appraisal. The appraisal, we have to provide to the VA a copy of the contract. And so what would happen is that if he picks it up, then he would just have to be refused, right? The agent that would allow him in would say, okay, you're not allowed to do this appraisal. So somebody's got to police it. I don't think that we police it. We just send in the contract. We might point out the special steps. I don't know. But that is, that's what I've heard a lot of people do. So what was the feedback, Matt, that you said somebody said that it wasn't ethical?
Yeah, somebody in the appraisal group said, hey, this isn't ethical to let out a specific person. But the only thing is it looked like the agent had done it. And so it was like if both buyer and seller agreed that this particular appraiser shall not do the appraisal due to conflict of interest or whatever, then that's something that, as long as it's written as, hey, the client is wanting to, the client wants it, not me.
Yeah.
Because it'd be the same thing if the client was like, oh, I heard this nightmare home inspector.
Yeah,
He
right,
makes
right,
stuff
right.
up. I don't want him to
Right.
be the home inspector. Well, that's not me. That's the
Right.
client.
But
So
what in the sense of they don't know who that person is, and they do get assigned to it?
well, you can pass that information along and oh no, how'd you hear that? No, somebody told me so.
Okay.
So that was the amount of research I could do there, but it is an issue. I mean, it's a known issue right now with.
I've put it in listing agreements too, because
That's what I was gonna say.
the homeowner themselves has to say who's allowed on the property,
Yeah.
regardless.
Yeah.
And I don't put anything about the appraisal or anything. I just say the name and it is not allowed on this property.
There's a restraining order against us.
Essentially, yeah.
Dang.
Yeah.
So
from now on, every contract I have is going to say Lincoln Walters is nowhere allowed on this.
Not allowed to set foot on the premises.
And the one who complained was the lady he works with.
okay.
Because he's named like 25 of us, so I'm on the list. He's named several of us because he's seen my contract, I guess.
You talking about inspector?
But no, this is Clips. But so he's filing lawsuits on all of us and all this stuff. I said, come on.
Wow.
I had Tim Arrowood do that.
That's
one.
insane.
Yeah. So anyway,
How do you get this list?
how do you get this? You want to be on the
You're
list?
probably on it.
Pretty sure I'm on it.
I thought you were taller. And I'm like, yeah, you're taller.
Yeah.
Yeah, you walked in and you're taller. So second thing was we're going to talk about flip rules for FHA. I don't know if you guys are familiar with those. So could you do me a favor, sir? Could you pass? There's two each. You can just pass those out. Actually, I probably need one of them since I don't want to talk. I had Paul put this together for us. There's one.
There might be some misspelling errors in there.
If I did it, probably. But he's the one that I'll send an email. He'll send it back to me and say
Correct it.
Yeah, I can mark it with the red pen.
I don't want to see airplanes made out of these kids.
Yes, sir, Joey.
So
This house is prison.
So we're talking about flipping and house flipping. So are you buying and flipping, or are you doing some of that? Or?
I'm not flipping yet.
All right.
Not right now.
So the question was, when you got a listing and it is a flip, or you're doing your own, then what are some things to be concerned about? What do the lenders care about it? So really it boils down to the only one that really cares is FHA. Conventional USDA and VA, they don't care about when it was bought. They don't care about how much it has appreciated since it was bought, anything like that. So the one that really cares is FHA. So what we're looking for is that if somebody bought a house on January 1st and they flipped it, or they did all the work in a month and they put it on the market February 1st, then for a significant increase in value, then there's a FH, and somebody wants to buy it with an FHA loan, then there's some stipulations. So the first stipulation is you have to be within the contract on the purchase of the property has to be within, at 91 days or later from the initial purchase. So so whatever 91 days is, now you can get under, we've done this before, we get under contract in less than 90 days, but there's an understanding that when we get to that, we're gonna have to have a completely new contract with the new dates on it, right? So everybody's gotta be okay with that, the sellers and sellers agent, those kind of things. So and for the first 90 days, I mean, so we can't close any quicker than the first 90 days. So the second thing is that, so let's see, it applies to properties that have, on the second page, if they define flip rule, applies to properties that have had title and ownership transferred even via quick claims and warranty deeds in the past 90 days. If one or more of the original owners quit claimed off the title, you may still bypass the flip rule if one of the original owners is, those kind of things. And a transfer title from business or an LLC doesn't really trigger the flip rule. But you cannot have a closing date less than 91 days from the title change. And then if it's between 91 and 180 days, there must be a second appraisal about that it says the lender should pay has got to pay for it. So we've got what we're looking for is there's a significant increase in the value of the property. So first appraisal, we want to make sure that the value is really there. What we're trying to avoid is fraud from the standpoint of, we bought this place, we painted it, and now it's worth $100,000 more, right? So it may be, but we need to have two appraisals to verify that. So, and the onus is on us, according to Paul's notes. If this isn't right, then it looks like Paul's paying for appraisals here. The second appraisal ordered that the lender shall pay for if it's resold for less than the sales. Okay, so if you bought it and then you're selling it for the same price or very similar to the same price, then you don't need that second appraisal because it really hasn't appreciated in value. So that's one. We used to see a lot of that. I used to do a lot of work with Nugan houses when they were. I still do, but they went through a period where they were doing a lot of. We were helping them directly, and now they work through agents. But so they were turning things quickly, and that became a challenge, timing and things like that. But right now, getting things done and in that short amount of time usually isn't an issue. And many times we run into challenges where just FHA loans weren't getting the opportunity, because of the market. So, any questions on FHA on the flip? Is that helpful? So, the other thing Matt and I talked about was super quick closing dates, the pros and cons. And so, from our standpoint, most of the people that we worked with, that we've actually fully underwritten them. So, so it isn't as big of a problem. We can move pretty quickly. But the big thing is if you're working with somebody and we're not sure, we pre-qualified them, but there's a lot of stuff that may go on. We just don't want to run the risk of, we'll just get an extension, because it's a pretty good possibility that there's a backup offer, or if there's something happens and the seller is for whatever reason, they're not, obviously we know that they're not obligated to extend. So we can, typically, if somebody's fully pre-approved, we've gone through the underwriting. All we need is appraisal title. So it just depends. Hello, the party's here. Oh, you're fine. Other than the fact that I can't keep anybody's attention now that the kids are here. Like, let's just look over there at them. Yeah, they're the stars. Let's see. We're going to talk about investor-related discussion. What we talked about, Matt, was there was a change with Fannie and Freddie that says if you bought a place and you're going to retain it and you wanted to cash out, it used to be you had to wait 6 months to do a cash out. So if you're going to buy a place, remodel it, and you're going to do a BRRRR method or something like that, then you wait 6 months and then you can do a cash out. So Fannie and Freddie has changed it to where you got to be 12 months. So you have to wait 12 months to get that cash out.
Is that to kind of decrease the investor portfolio?
I'm not really sure. I mean, there's been more politics injected into Fannie and Freddie in the last little bit than I would have expected. Because, like, you got this issue, which, I'm not really sure the reason, honestly, to answer your question. But I've seen that, and there are some, what we call LLPs, loan level pricing adjustments that have been imposed on rates and things like that for conventional loans, that normally you would think the higher the risk, the more expensive the rate. Well, what's happened is Fannie and Freddie have imposed some things that says, well, we're actually going to, if you looked at the chart and the way it's all set up, it's actually encouraging Fannie to take on more risky stuff. Yeah. Can't take it anyway. So there are some things about that are, it seems strange. Like the pricing would be better for somebody with a 700 credit score with 5% down than it would be somebody with an 800 score with 20% down, which is really wonky. Because as far as if it's purely risk based, then that just doesn't make sense. But they're like socially engineering to where we're encouraging people. And so what's happening even today on the way here, I talked to Paul and he said he had pre-qualified somebody for FHA, but when he started to look at the pricing, it was better for them to do a 3% down conventional because of the pricing. The mortgage insurance ended up being less, and then the rate was much better. And it wasn't that way 2 months ago when we pre-qualified. So let's see. You can still do delayed financing. So if you bought a place with cash, no financing at all, then you can do delayed financing. Where let's say somebody's got cash, they're going to pull it out of an investment, they're going to buy a property, but they just want to be able to do that quickly, but they wanted to be able to do financing, what we call delayed financing. So I want to take advantage. I want to get this offer, except it's only do cash, but I'm going to put some money back in my investment, so I'm going to get a loan. So we can do delayed financing in less than 12 months, but it has to be totally cash. But so if you borrow $30,000 and then use $300,000 of your own cash, that's still considered a financed property. So you'd have to use all cash. So and then and if you're doing any kind of cash out, it's going to be based on the purchase price, not the after repair value. So if you go in and put $20,000 in it, and now it's worth $50,000 more, you don't get advantage of that in the first 12 months. After the 12 months, then you can do that. So let me see. And then the DSCR, I've talked about this before, but DSCR stands for debt service conversion ratio. It's a program where typically when somebody's buying an investment property, then we're concerned about borrowing money at all. We've got cash, credit, income. So we're concerned about the income that you have, because that proves to us that you have the ability to repay.
Do you take into effect on an investment property the cash flow that it will bring in?
I'm glad you asked. So this particular program is designed just for that. So it's called a DSCR, but it's an investor cash flow program. So the idea is if the appraiser says that it will, let's say the payment is $1,500 a month, and the appraiser says, yeah, it'll rent for $1,500 a month, then at that point, we don't care if you have any income. We care that the income is the property cash flow.
Right.
So it's a great program. A lot of folks have got money, but they don't have the real income to go with it, or it's difficult to show, right? They own businesses and things like that. Then the rate's going to be a little bit higher, but to get it done, we've talked about with Matt and some of you all about some investment property with some of the group. The rates aren't the best, but what happens is it's an easier loan. So what will happen is somebody will, we don't care how many other rented properties you have or mortgage properties. So, and what happens, I think the best place to start is with a local bank, right? They're going to have 15 down. What is the program that you guys have done? Like 15% down, like a 20-year, 15-year fixed, it's a 20-year amortization. 15% down on a conventional loan for investment property is pretty good. But what happens sometimes is that the more complicated things get, the bank wants to see every year. They want to see, let me see your balance sheet, your income statement. They want to see all that information every year to make sure that you're still legit, so that they'll continue to service that. They could pull the loan if you don't. or they'll call it, I guess would be the term. So, so with this particular program, you don't have to provide any of that stuff. And so a friend of mine owns 5 businesses here in town. He bought a place on the lake for $1.5 million, and he calls me up after he's under contract and says, "Hey, can I get a loan? How much time do you have?" I got 30 days, and he hadn't even started the process, but he's in great shape. He intends to pay the place off in 3 years, so he's got pretty good cash flow. But he said, "I got 5 businesses, and it'll take me 90 days just to get the P&Ls caught up to where you need them." And I said, "Okay, we have that one path is the lower rate, lower fees, but the other one is this investor cash flow program." So we wiped away all the effort in getting any tax returns, anything. And all we cared about was did it cash flow. And so he had the money to put down, we proved that. His credit score was generally the better, like he could do it probably down to 680, but generally you're gonna wanna be 700, 720 plus. And then we didn't really care. The appraisal said, yeah, it'll rent for this, then we can move along with it. So we were able to close in 30 days and didn't have to get into all his business, right? So it's an interesting program. I've done a couple of them, and I'm working with a couple of realtors down in Pigeon Forge now, and like one guy's got 2 houses, 2 $1.6 million log cabins down there that we're looking at putting. He's got them on the market, and so we're looking from a marketing standpoint, how can we help him? So these particular cabins have been renting. He said they cash flow, or their rents were $140,000 to $160,000 a year.
Was that Jay's? Was that Jay's stuff down there?
No, I don't. No, this is the agent down there that I know. His name is Dustin Weaver. Dustin Weaver. So he's the one, Matt, that I recommended for coaching for you guys. So what we're looking at is like, well, we can go back to the people that have actually been doing the property management for them, and we can get the last 12 months of statements showing their cash flow or their what the income has been, and from there we can determine how much will it cash flow, and so we can put together a flyer that says if you have a credit score over 740 and you have this much money, you can buy this place. Yeah. So we don't care about your income. So and for them, it's an Airbnb or VRBO, so that's where it's really helpful to have, because the one on the lake we did, it really didn't quite cash flow, because we were looking at just regular monthly rents. But if you've got a history of a VRBO or Airbnb, then we can show the receipts and show for 12 months, this is my occupancy rate, here's all those different things. Then, it's, if you're doing 160 a year, then, you can afford a pretty good monthly payment on a place. So, let's see. Oh, and this was just something that Matt asked me, it's been a couple weeks ago. He said, "What's up with the mortgage people? They're just jumping around." And so I said, "What do you mean, just jumping around?" Or, So a lot of people moving. A lot of people moving around. Yeah. So
A lot of bigger names too.
yeah. So I've said this for a while. I'm telling you what I've been told, but a lot of the big guys are going to be fine because they got deep pockets. The little guys are going to be fine because they're nimble. It's the medium size, not the local branches. Like the local branches, we typically do our own thing. It's the companies that they work for, and so it's there's a lot of consolidation, what I call forced marriages that are happening, because wonder why they went there. Like, well, the company was going to be sold, or they were going to be merged with somebody else, and so it's like, wonder why that. And so, they'll try to spin it and just say, well, this was a good fit for us, which it is. But there's just a lot of turmoil. And there was a statistic that that's been floating around for the last couple months or couple weeks, is that in the last quarter of 2022 and the first quarter of 23, that the average mortgage company lost 100 basis points for every loan that they did. And a basis point is like a percentage. So 100 bips or 100 basis points is 1%. So if you're going to do a $100,000 loan and you're going to lose $1,000, that doesn't mean the local branch is losing $1,000, but the company is losing $1,000. So it's hard to make that up in volume, right? So, we did 10 million. Okay, well, I just lost, that much more. So there's a lot of, what's happening is the people with deep pockets are subsidizing things, and now, it's like, oh, it's gonna turn, and then it's not turning. So there's gonna be a lot more consolidation in the second and third quarters. So I don't know how that will affect us locally, but so, then my last thing is don't be clever, be Bob. So this is my, so there's the coaching company that I work with. The guy's name is Carl White, and he talks about a story about he hired a guy named Bob several years ago to make phone calls for him and set appointments. And after Bob started, he realized that Bob wasn't the sharpest guy, sharpest knife in the drawer. So, but he gave Bob a script and gave him a list of people to call. And so he just kind of sits him in a room and says, make these phone calls and say these things. So he starts making phone calls, and he says, I got one. He's like, what are you talking about? And then a little bit later he says, got another one. And so what the moral of the story is that Bob wasn't really creative. He just said what was on the script. He was just doing it, right? He was grinding, and he was just making the call, and he wasn't like, oh, I need to say this with this flair, and I need to do this with this, or I need to put my spin on it. It was just like, he's just reading the script. And because he was doing the work and following the plan, then Bob was really successful, right? In spite of his perhaps lack of, just his personality or whatever it would be. So, so when it comes, I know you guys get a lot of good feedback and coaching and things like that. Sometimes, and I have to tell myself that, I like to be creative and do stuff. And Misty will tell you, it's like, come on over here, Tim. Like, let's stay back on where we need to be, and not let's focus on the stuff that makes us money. And so I think I would encourage you all to do the same thing.
Oh yeah, tons of new agents will do that. Get distracted, and waste a ton of time. Spend 2 weeks making their business cards perfect.
Oh yeah.
Spend a month making your Facebook perfect.
Yep.
A month making your website perfect. And
Yep.
7 years
Still
in,
fun.
my Facebook still is pretty basic.
Yeah.
You can have a Facebook.
Well, you mean you're not been banned? Wait a minute, that's your personal one. I'm talking about.
I haven't been.
That is restricted.
In a year. Well, it's Trump's been
I'm
in
not.
office for a while, so
I'm
you're due. So that's all I got. So any questions, anything that I can help y'all with?
I do actually have a question.
You in the front, what can I do for you, sir?
Well, how's the sky blue? I'm just kidding.
Why is this?
With
Sorry.
down payment, how does can somebody go about pulling out like 401k? How does that? What do they need, like documentation?
Yeah. So when somebody is going to take money out of their 401ks, first thing we do is we need to get it. We first need proof that there's an X amount of money in there. We can usually generally access up to 60% of whatever they have in there. And so that's the number we use off the bat. And then what we'll do is we need a copy of the bylaws of the plan that says typically people are going to take money out as a hardship to buy a house. So there's usually a part in the plan that says to do an early withdrawal for these hardship issues. It could be, the one we focus on is buying a house, but it could be health issues, it could be other things. But in order to access it, so we would need proof that says you can actually access it. Most people can, but if we would need to, these are the, there's a penalty or not a penalty, all those different things. So we would look at that, and we just, at that point we would, we're going to say, how long is it going to take for you to get it out? Do they say they can have the money wired in a month, then, or 2 weeks, that kind of thing. So it's pretty straightforward. Hello. So is that helpful?
Yeah, very. Honestly, it was just one of those things I was thinking the other day. I was like, I wonder how. I've never had that situation pop up, and I'm sure it has.
Yeah, it's quite often we see it. And oh yeah, one lesson learned in the last 2 weeks: don't bring a third-party check to close it. It won't work. They won't take it. Just want to let you know. Even though it's $14,000.
Describe like a party check.
Yeah, like a friend or family member wrote the check.
A third-party check meaning that the guy got a check from his bank mailed to him, and it was made out to him. And he was going to endorse the check over at the closing table, right? And then, so we all arrived at the closing, and so she's got money from a different checking account. So anyway, and their bank, they're moving in from out of state, so their bank's 600 miles away.
OMG, Cat.
And so we're like, can you have them wire the money? Well, I have to be there in person to get the money wired. All this stuff we kind of figured. So it was an investor selling the house, so it wasn't a domino effect, or people weren't affected that much, but, so, tell your people, I mean, we tell everybody, you know, don't bring personal check, it's gonna be certified
cash
funds.
either.
Yeah, well, yeah, certified funds or wire transfer.
What about the rolls of quarters I got?
Most quarters. You know, I think they'd march you right down to the bank and say, you turn that into a piece of paper for me. So.
We had a fellow roll into classic with a suitcase of cash.
He said, I always wanted to come to a closing, like get a briefcase and then just put like 20s on the top and have a little paper underneath and just put the little things and say, I'm here for the closing. It's like,
We ought to do this.
so, or get one of the metal ones with the
handcuff.
to it. So, anyway, that's all I got.
Thank you so much.